Hello and welcome to Livewire Markets. My name's Tom Richardson and today I'm sitting down with Steve Johnson, the founder and Chief Investment Officer of Forager Funds Management. Steve's going to talk to us about their great performance over the past year, how he thinks about making money in markets and Forager in general. Steve, welcome. Great to have you here.
Hi Tom, great to be on.
First up, can you tell us about Forager and its investment philosophy?
Forager is a funds management company that I started 15 years ago. So it's been around quite a long time, still quite small though and independently owned. And our philosophy is really unloved and underappreciated. We're looking for opportunities that other people are either fearful of or misunderstanding. That tends to translate to a pretty heavy skew towards the smaller end of the market where there's a lot more inefficiency.
Okay, markets a bit dicey at the moment. You've said you can prepare for but not predict market downturns. So what do you mean by that?
Yeah, we run two funds, one's global and one's ASX listed. I'd say the global one's got a lot more thinking needs to be done. We're relatively insulated here in Australia, although we run through the same process in terms of running the portfolios. I would say we run a really valuation heavy process at Forager, and that tends to lead to some, I guess, macroeconomic calls. When things are expensive, we're not finding a lot of stuff that's unloved and underappreciated. We tend to hold more cash. We tend to hold more defensive businesses from a valuation perspective, but that is usually at times when people are being overly optimistic as well. And our whole approach is built around that. It's not let's make a forecast that Trump's going to come in and bring in all of these tariffs, but let's build a portfolio that is resilient to a range of different scenarios, and more importantly for us, gives us the opportunity to capitalise on any turmoil that might arise.
US shares have had this exceptional 15 years, but you mentioned Donald Trump's put up these trade barriers. So do you think we are really at a turning point in terms of global markets? Is this era of US exceptionalism over?
I think it had been overdone in terms of people's optimism about it and the price that they were willing to pay for it. I still think there are some really important attributes about that part of the world that make it a market that we will always be invested in to some extent. We are significantly underweight that part of the world at the moment, but I still love US companies that have got great management teams. I find the governance is better, the capital allocation is better, the willingness to really go and grab an opportunity is stronger in the US than it is in other parts of the world. For us, that all flows into what price am I willing to pay, and I think the later half of 2024 into the start of this year, there was so much money just flowing into that part of the world that the prices were too high, even though I like some of those attributes about that part of the world. So for us, we were finding better value elsewhere. I still think there's going to be some great investment opportunities in the US over the next decade or so.
So if we assume you do have some valuation worries about the US, where else should people look to invest?
I mean, we've been pretty heavily invested in Europe and the UK for most of the past 10 years and done really well in that part of the world. It's the flip side of what I'm saying about the US. There's lots of macroeconomic things to worry about. The governance frustrates us. The focus on, or the lack of focus on shareholder returns is frustrating, but you're paying prices for businesses over there that are fractions of what you pay in the US. And we've been able to find opportunities that are generating lots of cash flow, paying fat dividends, and I'm talking dividend plus buyback, cash returns in excess of 10% per annum. So the European banks, Tesco, all been great returners for us over an extended period of time. Despite not having massive share price appreciation, we've had really good yields from some of those businesses. So Europe is one. More recently for us, Japan is really interesting. There's some pretty significant, I would call them governance changes taking place there. It's being driven by government in a lot of cases, but there's a really big change to some long-standing things in Japan that people thought might never change. One is capital allocation. There is an increasing focus on giving holders some of the money, unwinding some of these very complicated structures that companies have and really focusing on creating shareholder value. And then the other one, and it's a big one for our fund, is the digitization of the Japanese economy. There is an extraordinary amount of things still happening on paper over there that we take for granted happen digitally. There's a massive push from the government, and the companies are really starting to get on board to move that economy to where the US and Australia and the UK are now, and it's 10 years behind. So the opportunity for the zeros of the world that now live in Japan are huge because they're where zero was 10 years ago.
Is there any particular stocks you want to talk about in Europe or Japan that you like?
I mean, I've already touched on the banks and Tesco in Europe. I think those large staple businesses are still very, very attractively priced and are going to give you very sensible, unsexy, but sensible returns over extended periods of time. I'd say in Japan, most of the stuff we own there is very, very, very small. So I won't talk about it in this, but I think that as a category, small cap Japanese tech is going to be a very interesting space over the next 10 years.
Okay, another asset class on a massive bull run over the past 12 months is gold. What do you think about owning gold?
Well, we don't own it, unfortunately. It has been a massive run and it's been a really nice, protection against some of the turmoil we've seen in the global economy. Look, I find assets that don't actually pay me cash. I would prefer to own real assets that are part of the economy. For me, that's shares because it's where I'm most familiar. I think property is also a similar type of asset that you're going to own something here irrespective of what happens to the economy. I find gold difficult because of that. It does not pay you any return. So it's not an asset that I've always ever been particularly excited about owning, but I think you've seen the role that it can play as a defensive asset in people's portfolio. It's done that really well over the past 3 or 6 months, and I don't expect that to be different into the future.
You made your name in small caps. Aussie small caps are a specialist area for you, but you said the market in Australia has become distorted for small cap investing. Why is that, and how can you take advantage of it?
Well, to start with, it's been a bad place to be invested for the past decade and particularly the past 5 years. So you've had underperformance of the All Ordinaries Index of a magnitude of 30 to 40% cumulative over the past 5 years. That naturally means there's less money flowing into that asset class, so that's causing some distortions. We've had this dramatic shift from active funds management into passive. Most of that money in passive is flowing to the larger end of the market. So again, there's even less capital flowing into the small caps again. And then again, because of the performance, but you've seen quite a number of larger small cap funds actually have to close down or suffer redemption. So you've had all of this natural selling in the small cap part of the market as well. And that has created overall depressed valuations, but I think more importantly for us, a huge gap between the small cap stocks that are big enough to go into, say, the ASX 300 to fit into the larger small cap managers' portfolios and what is not in that bucket. The gaps between the valuations are enormous, and we've had a lot of success over the past couple of years trying to identify the company that can get itself out of one bucket and into the other where those passive valuations and flows start to apply.
As a small cap investor, what are the key qualities you look for in companies?
I would say increasingly for us, can it get big enough to attract some interest? I think pretending that this passive trend is going to go away is just sticking your head in the sand. It is going to be with us forever, and overall it is a wonderful thing for investors. The amount of fees that people are saving is very significant, and I think it's a good thing, and it's going to continue. So for us, I'd say in that small cap space, that has led to us focusing on unloved and underappreciated businesses. So we want to buy them when nobody else is interested in them, but can we find something that can grow into something that people are going to get interested in at some point in time? Now, those principles apply for us across the market cap spectrum, but they're even more so at the small cap side of things. So it's not just crazy growth, but can this business be something that is going to appeal to people at some point in time is a key part of, I think, what's working really well out there at the moment.
How long before a company is added to the index would you typically look to buy it?
I would say that's not exclusive for us. We do own companies that are never going to go into the index because they're cheap enough. It's a factor that we put into what's the right price to pay for us to pay for this company, and we'll buy something smaller if the price is correspondingly cheap enough. I mean, typically we're willing to invest for 5 years is our time frame. I would like to see really good evidence of a business delivering results that are consistent with our thesis inside the first 2 years, but the market may not recognise that straight away. So our time horizon is 5, and I think being early and building up our position in some of these companies is something that we can do that a lot of other people can't. We have very patient, long-term investors ourselves. We have a business that's independent, not dependent on any institutional shareholders. So we can have that long-term time horizon that I think some other people find difficult. And we're not, as long as the business is achieving what we want, we don't get too distressed about the share price not working in the short term.
So once a company's actually been added to the index, you get that tailwind, that kind of valuation appreciation through the index buying, and you can then keep holding it indefinitely, or would you kind of look to trim the position or sell it, or?
I mean, we can keep holding it. I would say by the time, our whole approach here is unloved and underappreciated. And when a company is no longer unloved or underappreciated and everything that we like in the business is factored into the share price, we've normally moved on to the next thing that has become unloved and underappreciated since we first bought that stock. But there are exceptions to that, and it's really important that we capture as much of the upside from the things that work as we can. They don't all work. We lose money on some investments, and when they do work, it's a big change for me over the past 5 years to say, you know, we need to make as much money as we can out of that. And you know, we still own Catapult, for example. It's going to go into the index this year, I would say, based on its current market capitalisation. I still think that is a truly global ASX-listed business that has a lot of growth ahead of it. Yes, it's more appreciated in today's share price, but I still think it's got a lot of room to continue to grow from here.
Any other small caps you think people should be looking at?
Look, I think there's a lot of companies out there that are suffering really bad share price performance over the last year. You know, the small cap index is negative over the 12 months to 31 March. You've had businesses like Johns Lyng go from a $7 share price down to a $2, a very, very popular stock that was trading at 40 times earnings. That's now quite an unpopular stock trading at 11 or 12 times earnings. So there's a lot of companies in that category. We've recently added that stock to our portfolio. I still think the software space in Australia is quite interesting. It's come back, and one that we've owned for quite a lot of time. There's a couple of little I guess fintech, you would call them, companies listed in Australia that are really starting to get to some scale. We saw Plenty actually reported this morning as we're recording this. It's now up to a $2.5 billion loan book. It's profitable, it's generating cash flow, and the share price is down a long way over the past 4 or 5 years. So I think for those that like looking for the unloved and underappreciated, it's one of the really good things about this market, because that gap is still so wide. You can recycle out of some of the things that have worked and into some things that are deeply unpopular at the moment.
And Plenty's lender to consumers?
Yep, so auto loans, personal loans, solar loans, and they're basically a platform. Their funding is to try and securitise most of those loans once they've written them, and they collect a margin on the loans that they've written and pay some of that away to the people that have funded them and keep the difference. It's a real scale business. It has taken them until they got to a $2 billion loan book before they were profitable at all. They think they can have a $3 and $4 billion loan book without the cost base changing much at all. So as that grows, you're starting to see more and more profit drop through to the bottom line.
And is that a business that could potentially be added to an index and get that tailwind?
Yeah, look, I would say still years away. That is going to need to probably be a $4 and $5 billion loan book before it's a $700 and $800 million market cap for the company. But some really good early evidence, I would say, for us there that we're on the right path towards that. Yeah, this is a highly cyclical, economically dependent business, so we keep our portfolio weighting fairly small in a company like that. If we have a recession, their borrowers are going to have trouble repaying their loans, and that's going to impact on the company's profitability. So there is more risk there than there is in a company like Catapult, and that's why our portfolio weighting is much smaller.
If a company does get added to an index, typically how much value appreciation do you think that company can get just by virtue of being added to the index rather than its profit growth?
Yeah, that's not I wouldn't say it's a hard point in time, because everyone can see the potential index participants coming. And like I said earlier, I think there are fund managers that are able and willing to buy a company that has a 600 million market cap that couldn't buy it when it was 150 or 200. So the valuation premium will grow to there, and then it will grow further if they go into an index. But, you know, for example, I'd say we've seen a company like Gentrack go from $1.50 share price to $11 share price, and I'd say half of that was just the revenue and the profitability of the company is growing, and if you applied the same sorts of multiples that were applied, you'd still have a much higher share price. And then you've gone, well, if this company's in the index, it maybe trades at a 50% multiple premium, but all of that is very opaque. It's not an exact science, if that makes any sense.
So these index tracking funds, they're kind of like exit liquidity for you active managers.
Well, yeah, and like I said earlier, we've got to get that right, though. There's no reason for us just to exit just because the passive money comes in. But you see the liquidity, Catapult has gone from trading maybe on some days as little as $50,000 to currently trading $1.52 million a day. So the option is now there for us to sell that stock on any day that we want to exit our position. Whereas when it was tiny, that illiquidity, and for us, illiquidity is a risk. We want higher returns in a smaller company that has less liquidity than we have in a bigger one. So now as that company has grown, it's become less risky from our perspective and the liquidity has improved, we've been willing to hold it at a lower expected future rate of return than it was a couple of years ago for us.
Okay, and you've had this fantastic performance for your small cap fund over the past year. I think you were number one in the Mercer tables and you kind of thumped the people in second place. Do you want to just talk a little bit about what drove that?
Well, look, 5 years of really hard work and team contribution at Forager. I'd say our portfolio management team has been together now for 7 years. Collectively, we've put a lot of work into improving our processes, and particularly all that portfolio management stuff you and I have been talking about. I think the buying unloved and underappreciated stocks, it's always come really naturally to me. Getting the right weighting at the right time is something that we've learnt a lot about. And that team sticking together has been working really hard for the past 5 years. So it's great to see a good 1 year number. It's more important for us to be seeing really good 5 year numbers and to see the process working. I think in funds management land, you see it in the fin review all the time. There's the 1 year numbers can jump about all over the place depending on what's working. So the focus for us is really on the long term, but it's great to see some recognition of that hard work that's been going on over a very long period of time.
Okay, maybe finish on the outlook. We've covered a lot today, markets, portfolio management, but what sort of returns do you think investors should expect from local and international equities going forward?
Start with globally, it's got a bit better. I think multiples have come back a bit with this sell-off, although that has unwound a little bit in the last week, and who knows by the time this is showing. But I think you've gone from what I would say are prices that are only going to give you 6 or 7% returns. Let's put this into context first. 100 years of returns, you've made about 8% per annum from international and US equities and also from Australian equities. There's some pretty logical reasons for that. So that's your baseline expectation. If things get too expensive, you're going to make less than that. And if things are cheap, you're going to make more. I'd say we were at the expensive level globally a few months ago. That's probably come back to something a little bit more normal to a touch expensive. So maybe your 8%, you can expect to make 7% per annum over long periods of time. And here in Australia, the ASX All Ordinaries has done 8% per annum since we started our Australian fund 15 years ago. It's not been outsized returns from Australian equities, and I think that sets you up for some pretty sensible returns from here into the future as well. I'd say something similar in that 7 to 8% sort of return, a combination of dividends here and capital growth.
Do you have a targeted return for the small cap fund? Or?
I mean, our job is to earn people more than that. So, and internally we say that's 2% per annum better than the index after fees. Our clients should be happy with that, and that's adding some value to their portfolio. We do suggest that most people put both of our products together with either some low-cost index funds. Some of them have their own blue chip portfolio at the core of that, and we are 10 to 20% of their portfolio on the side. The aim is to generate them that excess return, but they get their core equities returns at a low cost to the extent that they can.
Okay, Steve, that was brilliant. Thank you very much.
Thanks for having me on.
If you like that content and want to see more, please visit our website at livewiremarkets.com and our Livewire YouTube channel.